Welcome you all to the today virtual program on professional opportunities at Gift City. Uh, Let us stay for a motto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता
Arthashastram, Dharmashastram cha, meaning the entire world is deliberating about impact of climate change coupled with disruptions of artificial intelligence. India has given philosophy of Vasudhaiva Kutumbakam to the world and successfully hosted G20 summit on this theme and also launched Global Biofuels Alliance. The accounting profession also has an enormous responsibility to guide the world, where accountability meets innovation so that vision can be converted into solution. The Institute of Chartered Accountants of India, being the world's largest accounting body after the successful hosting of WCOA 2022 and GLOPAC, proudly presents before the World Forum of Accountants 2025. Where accountability meets innovation for a sustainable planet. The world's brightest minds will exchange insights, explore emerging trends, and unlock the possibilities for the profession. Where foundation will be laid to shape the vision for the future of accounting profession. Hosted at Yashobhoomi, the largest convention and exhibition center in the heart of India's capital, New Delhi, inaugurated by the Honorable Prime Minister Shri Narendra Modi, is all set to host the congregation of accountants from around the world. And while you're here, experience the vibrant culture and heritage of New Delhi, a city where history meets modernity, offering unforgettable memories.
World Forum of Accountants, an experience of 3 days, insightful discussion, groundbreaking innovations, and unparalleled networking opportunities.
With immense pride, we invite you to WOFA 2025, taking place, happening from January 31st to February 2nd, 2025 at the magnificent Yashobhoomi, New Delhi. Experience 3 days of insightful discussions, groundbreaking innovations, and unparalleled networking opportunities. World Forum of Accountants 2025 is where you need to be, where accountability meets innovation, AI for a sustainable planet. Join us at WOFA 2025 from January 31st to February 2nd, 2025 at Yashobhoomi, New Delhi. For more details, visit wofa.icai.org.
I'm very happy to introduce today's speaker, Ms. Amrin Alwani. Amrin Alwani is a chartered accountant, a company secretary, and a lawyer. Amrin is currently working with Kanthar Mehta and Shah, chartered accountant, as an associate director. Before joining KMS, Amrin has worked with KPMG Ahmedabad for around 4 years, as well as has owned and managed her own practice as an entrepreneur for 6 years in Kutch region of Gujarat state. Amrin has over 11 years of experience under the various service heads, including litigation, consulting, and advisory services. During her tenure as a professional, Amrin has dealt extensively in the areas of foreign trade policies, customs, GST, and erstwhile indirect tax laws, service tax, central tax, value added tax of various states, and central sales tax. As a part of her overall experience, Amrin has also contributed to various association, tax committees, publications, and Chamber of Commerce, such as FICCI, CII, and other technical forums of Gujarat Commercial Tax and ICI. As an enthusiastic lawyer, she has also worked on many litigation cases in the areas of indirect taxes, including appearances before tax tribunals. Amrin was member of Indirect Tax Committee, FIRICI, Ahmedabad branch for the financial year 20 to 23. Amrin has been appointed as an co-opted member of Legal Service Committee of WIRC of ICI for 2023-24. And I also like to introduce CA Jaisha. Jaisha is a chartered accountant and a commerce graduate. He has over 13 years of experience in advising clients in tax and regulatory domain. Jay is a partner at iMark Advisors and Pankaj Kesha Associates. He has worked with Arthus Consulting, Dhruva Advisors, KPMG, and Reliance Industries earlier. Jay has significant experience in the area of M&A, corporate restructuring, Gift City, international tax, and FEMA. He has also advised clients on structures involving inbound and outbound investments. With this brief introduction, I welcome both the speakers to the today's CPE program, and over to the speaker.
Hello, good evening all. Thank you so much SIRC team for providing this opportunity for taking this session on Gift City. And a very warm welcome to all the participants as well. And thank you so much for joining this session. We hope that you will find this session a fruitful one. So I'll just share the presentation. All right. So the way we'll go about is that first we'll discuss an overview of Gift City IFSC. Then we'll discuss the direct tax provisions that are relevant for IFSC. And then Amreen will take up the indirect tax provisions. GIFT, as we all know, Gujarat International Finance Tech City. It is located in Gandhinagar in Gujarat. It has been approved as the first international finance service center in India. So the government had a vision to develop a particular region in India as an overseas financial hub in similar lines as Singapore, UAE, Mauritius. So considering the regime of such overseas jurisdictions, the government came up with the concept of having an offshore financial hub in India in such a manner that it can cater to India's financial service sector by offering state-of-art infrastructure. In order to align with this vision, the concept of IFSC, International Finance Service Center, was introduced. And in recent years, in the last 2-3 years, we have seen a lot of traction in IFSC, be it on the regulatory front, be it on the tax front, be it on the policy front. At every stage, we have seen immense response and reception from the government authorities in order to make this regime very conducive and give a boost to the IFSC. GIFT, as we all know, stands for Gujarat International Finance Tech City. So it's basically a fusion of finance and technology. So here we'll see the services which are eligible to be carried out in GIFT City. While there is a restricted list of services, these services mainly relate to financial services sector and technology, which we'll discuss in detail in the subsequent slides. GIFT is basically the idea of onshoring the offshore business. So the government had a vision of getting the business which was till date carried out outside India in the financial services sector to get it transferred to India, considering that it had a huge potential not only on the revenue front but also from a foreign exchange perspective. The entire GIFT project broadly can be divided into three zones. One is it's a multi-service SEZ, and that is where a lot of indirect tax issues come up, which will be discussed later on. There is a domestic finance center, corporate office and trade center, and then there are associated infrastructure, housing and social facilities in order to give a boost to the entire ecosystem. So as we discussed, GIFT is a financial hub. It's a globally benchmarked international finance and IT sector, and it targets mainly the financial services and IT and ITES sectors. This slide provides an overview of the important business opportunities which are available at GIFT IFSC. Why this is crucial? Before we delve into the direct tax and indirect tax provisions which are relevant for GIFT IFSC, it would be important to understand what are the opportunities that are available at GIFT IFSC, what all activities are permitted, so that we can identify the opportunities for our clients. We can have a conversation with them, identify what all services and activities they can carry out in GIFT IFSC in a manner that is not only tax efficient, but also it gives a boost to their business activities. So the key activities which are permitted in IFSC, and you will observe that every few months, this list is just getting expanded. So earlier, it all started with a very restricted list of banking, insurance, and capital market. And after that, based on the representations received, based on the overall response which the government has received, this list has just been updated with new list of services. So the first and most crucial sector which is permitted to be carried out in GIFT IFSC is banking, insurance, and capital market. So banks can set up units, branches in IFSC, both domestic as well as foreign banks. So they can set up a branch here in IFSC and they can do banking operations. The key operations which a bank in IFSC can carry out is that today, if we want to avail any external commercial borrowing, there is an Indian entity which wants to obtain a foreign loan, then it is possible. Then in addition to foreign financial institutions, there are overseas branches of Indian banks which can extend this facility. Today, with GIFT IFSC coming up, banks have started setting up branches in IFSC, and they are providing these loan facilities from the IFSC branch instead of the overseas branch. In addition to this, there are many other services which banks can provide, like export credit facilities. Then there would be discounting facilities. Insurance companies also have captured a large share of market in IFSC. There are many insurance companies which have set up offices here where they can cater to the NRIs. So Indian insurance companies setting up shop in IFSC, providing services to to NRI clients. So as we saw earlier, GIFT is basically onshoring the offshore business. So you can carry out all your foreign business, overseas business from IFSC. GIFT is basically a gateway between India and overseas. So similarly, there are many capital market activities that are permitted in IFSC. To name a few, stock broking is one of the most important and upcoming activity, which has gained a lot of traction in recent times. There is NSE-IX and there is BSE-INX. These are the two prominent stock exchanges in GIFT City, and we can see daily the news of GIFT Nifty volumes going up and gaining monthly highs. So stock broking is one activity where you can get access to trading in GIFT Nifty. At the same time, the capital market regulations also provide an opportunity to Indian stock brokers to trade on foreign stock exchange platforms without obtaining membership of those respective foreign stock exchange platforms. So what the IFSC framework allows such brokers is to enter into global access arrangements with the foreign brokers so that they can trade on the foreign exchange, foreign stock markets. In addition to stockbroking, there are other activities also which are permitted from the perspective of capital market. For example, investment banking is one. Then there is merchant banking. There are clearing corporations, depositories, which are permitted in the capital market segment. Similarly, fund is a very large activity which is having a lot of traction in the GIFT City. There are almost 100 plus funds which have come up in GIFT City. So fund basically in nature of alternative investment fund can serve as a vehicle for pooling funds from outside India, and those funds can then be invested by the AIF, the fund which is set up in IFSC in India. So very recently, till very recent times, we had seen Indians setting up funds in Mauritius, in UAE, in Singapore. The main objective of setting up funds outside India was to avail tax benefits. However, these funds were always focused on the Indian markets. That is why the government thought, why not provide a platform and opportunity to these kind of players to set up fund in GIFT City only, in India only, considering that they are India-focused funds, and manage the funds from India only. Because earlier what used to happen was that the fund managers, though they were located outside India, say for instance in Mauritius, these were always managed from India. And that is why there was always the risk of POEM, place of effective management, coming up in litigation. The department used to contend that these funds are managed from India, so their income, which though accrues are outside India, should be liable to tax in India. Now, with GIFT City coming up, these players are no longer required to shift their base outside India. They can just set up presence in GIFT City, have a fund management entity in India, and that fund management entity can manage the fund in India such that they avail the benefit of the GIFT ecosystem. Second is fintech. So as we discussed, GIFT is a fusion of finance and technology. So on the fintech space, what is allowed is that if there are any IT players who are developing technology platforms, technology solutions, which cater to BFSI segment, banking, finance services, and insurance services, then they can set up an entity in GIFT City and cater to the non-resident clients and GIFT City clients. So say, for example, there is an IT company which has developed a KYC product for stockbrokers. Then they can definitely set up presence in GIFT, and they can bill and invoice to the clients who are set up outside India or in GIFT City. And that entire income can be eligible for tax holiday, which we'll discuss later on. In addition to fintech, very recently, just as an offshoot, they have allowed payment service providers also. So say Google Pay, Paytm, and the like, these kind of entities are also now eligible to set up presence in GIFT City such that they can provide cross-border wallet services. Next is Global In-House Center. So if there are financial service entities outside India and they want to set up back office operations in India, say for example, there's a foreign bank and it wants to set up a back office operation in India, then they can do it under the Global In-House Center regulations of IFSC, such that they set up a presence here. They will have employees here who will be providing back office operations for support services to the foreign banks, foreign insurance companies, foreign stockbroking companies. There are also aircraft leasing and ship leasing activities which are permitted in GIFT City. Ireland, Singapore, Panama, these all have been hubs of aircraft leasing and ship leasing in past. Now, with GIFT coming up, we can see a lot of entities setting up presence here, and they can just incorporate an entity in GIFT, procure aircraft, procure ships, and then lease it either in India or outside India. And this entire leasing income can be eligible for various fiscal incentives. Next is International Bullion Exchange, one of its kind set up in India recently, where there can be trades in bullion depository receipts where the underlying is the bullion and silver. And there could be qualified jewelers and qualified suppliers who can trade in these commodities. So there are many UAE companies. We have been assisting many UAE companies in obtaining membership of International Bullion Exchange, who can then supply bullion to India. There are certain custom benefits which are available. And then there are also income tax benefits in form of trading in BDR because that becomes exempt. Similarly, here, Indian jewelers can obtain membership in Gift City in form of qualified jeweler. They can import bullion at reduced custom rates because of certain agreements which India has entered into with UAE. And then that bullion can be used by them in their routine business operations. Next is family office, an extension of funds where there are many global families who are now looking to invest in India. They can set up family offices in Gift City, and through that family office, they can invest either in India and even overseas. Last is the ancillary services. So ancillary services are basically not primarily financial services, but these are the services which provide support to the financial services. So for example, professional services, management consulting services, legal services, secretarial services, compliance services, services of, say, chartered accountants, which we provide to clients which are either set up in GIFT or to financial service entities. Those can be eligible to set up presence in GIFT and be eligible for the tax benefits in GIFT IFSC. Recently, the government has also allowed bookkeeping, accounting, taxation, and financial crime compliance to be carried out in IFSC. And a major relaxation which has been kept in these regulations is that you are not necessarily required to provide these services to entities which are into financial services. You can provide these services to non-financial units also. So essentially, your clients need to be either based in IFSC or outside India. So typically, outsourcing firms can now have a presence in IFSC under the BATF, Bookkeeping, Accounting, Taxation, and Financial Crime Compliance Services, and be a part of the GIFT ecosystem. So all in all, this provides an overview of what all opportunities are available in IFSC, what all services are permitted, because considering that GIFT is a multi-service SEZ, not any and every activity can be carried out in GIFT. So today, an entity cannot carry out manufacturing activity in IFSC. So because it's a multi-service SEZ and there are certain authorized operations only which can be carried out. And as we can see, this is the entire gamut of services which is allowed in IFSC. Now coming to the regulatory framework, the IFSCA Act 2019 governs the activities which are carried out in IFSCA. So in 2019, the government had set up International Financial Services Centers Authority, which is the nodal authority, the regulator for any activity which is carried out in IFSC. So as RBI regulates the entire monetary activities in India, there is SEBI, which regulates the capital markets. There is IRDA, which takes care of insurance activities. In GIFT, the government has come up with a separate regulator, which is positioned as a unified regulator, International Financial Services Centers Authority. So IFSCA basically regulates the activities which are carried out in IFSC. And if you are carrying out any activity in IFSC, then you need to obtain permission and approval of IFSCA. You don't need to go to SEBI or to RBI or to IRDA. So say, for example, if you are setting up a fund, an AIF in India, then ideally you will have to approach SEBI and take its approval. Registration from SEBI is required. However, if you're setting up a fund in IFSC in GIFT City, then you are not required to approach SEBI. There is IFSCA which will take care of your approvals. Similarly, if you're setting up, say, an insurance arm here, then IFSCA will be the nodal agency looking after the entire process. So in addition to IFSC Act, there are different regulations for each of the service activity which we discussed. There are notifications, circulars, guidelines which are issued from time to time to take care of the activities which are coming up in GIFT. Now, very importantly, an entity which is set up in IFSC that is regarded as a non-resident of India for the purpose of FEMA. This has been a game-changing provision because GIFT, while being in Gandhinagar in Gujarat, which is a domestic area, the government has carved it out as an offshore region for the purpose of FEMA. This implies that any activity which is carried out by an entity in IFSC with a non-resident will not be subjected to FEMA regulations because then it will be regarded as a transaction between two non-residents. Similarly, if there is any transaction which is happening between an IFSC entity and an Indian resident, that will be regarded as a transaction between an Indian resident and a foreign resident, and the FEMA provisions will apply accordingly. So say, for example, if today an Indian group is looking to set up an entity in IFSC, then it will be regarded as if an Indian resident wants to set up an entity offshore, and all the provisions of FEMA will apply accordingly. So say, for example, if you want to invest into a Singapore entity, then that Indian entity has to comply with FEMA overseas investment rules. Similarly, if that Indian entity wants to form an entity in IFSC, it will have to comply with these overseas investment rules of FEMA framed by RBI. Similarly, if there is a non-resident if there is an IFSC entity which wants to invest in India, then it will be regarded as an inbound investment, similar to an investment which is coming from, say, Mauritius or US or Singapore. Now we will discuss the relevant direct tax provisions. So as we discussed just now, for the purpose of FEMA, entity which is set up in IFSC is treated as a non-resident of India. However, for the purpose of income tax, the entity which is set up in IFSC will be treated as a tax resident of India. So this is very important. There are two different positions which are taken. While for the FEMA, you are a non-resident. For the purpose of income tax, you are still a resident of India. So the entity which is set up in IFSC will be treated in the same manner as a normal domestic entity for the purpose of income tax. So say, for example, the entity which is set up in IFSC will have to obtain a PAN, will have a TAN, it will have to file income tax returns, and just like any other domestic entity, it will have to file TDS returns. So all those compliances will apply in a similar fashion as an Indian entity. The only difference is that there are certain specific income tax incentives which are available to gift entities, which we'll discuss in a while. However, if there is a foreign company which is setting up a branch in IFSC, then that branch will be treated as a non-resident of India for the purpose of Income Tax Act. So similar to any branch of a normal foreign company, say, for example, there's a Singapore company which is setting up a branch in India, then that branch is regarded as a non-resident of India for the purpose of Income Tax Act, and that is regarded as a permanent establishment of the Singapore company. Similar to that, of a branch which is set up by a foreign company in IFSC will be treated as a non-resident for the purpose of Income Tax Act. Now coming to the most crucial provision and the reason why GIFT City is so much talked about and why it is an attractive destination for entities in financial services sector is the tax holiday provision under the Income Tax Act. So as we are all aware broadly, there is a 100% tax deduction available for a unit in IFSC under the normal income tax provisions for 10 out of 15 years. So getting into the nitty-gritties, there is Section 80 LA of Income Tax Act 1961, which provides this particular deduction. So earlier, you may recall, there were provisions of Section 80 IA, 80 IB, 80 IC, 80 I, say for northeastern regions, then for infrastructure sector, for telecommunication sector, for hospitals, hotels. There were tax incentives for different sectors and regions which were allowed under the Income Tax Act. Similar to that, government has introduced Section 80 LA of Income Tax Act, wherein there is a 100% deduction available to a unit which is set up in IFSC, such that its entire income becomes eligible for tax deduction. Now, this deduction would be available to any unit in IFSC, be it a branch, be it a company, be it an LLP. So any and every kind of setup in IFSC which is permitted under the IFSC regulations will be eligible for tax benefit under Section 80 LA. Now, an important question which arises here is whether any and every income of the unit would be exempt or only select income would be exempt. So here, very important to note that it is only business income of IFSC unit which will be eligible for Section 80 LA deduction. So say, for example, there is a banking unit, which we discussed just now. If it has set up a branch in IFSC, then the interest income which that IFSC banking unit earns, or there is a commission income, or there is any other income which that branch of a bank is earning, which is in nature of its business income, then that will be entirely exempt from tax. Similarly, if there is a stockbroking entity, then its brokerage income, because it is in nature of business income, that will be entitled for this tax holiday. insurance company, then its entire insurance premium will be eligible for the benefit. Fund manager, which is managing the AIF, its fund management income, which is primarily in nature of business income for the fund management entity, that need not be that will not be liable for income tax because of Section 80 LA. In addition to business income, very specifically, they have allowed income from transfer of an aircraft or ship, which is leased by a unit in IFSC, provided it has commenced operations on or before 31st March 2025. So we just saw that an aircraft leasing company or a ship leasing company can set up entity in IFSC. So say, for example, there is a company which has set up entity in IFSC and that is engaged in aircraft leasing. And today it has procured an aircraft. It is giving it on lease to various lessees. Say 5-6 years down the line, that company decides to transfer, to sell that aircraft. And if there is any gain on that transfer, then that will not be liable to any income tax because of Section 80 LA. The government had to clarify this because this kind of income would largely be treated in nature of capital gain. So had this clause not been inserted, it would not have been eligible for exemption because it is only business income which is till date allowed as tax holiday. But typically for aircraft and ship leasing companies, that this particular transaction would be eligible for tax holiday. On the flip side, any income from transfer of shares, say the fund has invested into shares and securities and that income is in nature of capital gains, that will still not be liable for tax holiday under Section 80 LA because it is only business income which is eligible. This deduction is available for 10 consecutive assessment years out of first 15 years. So this first 15 years will start from the year in which the registration is obtained from IFSCA. So say, for example, there is a unit which has set up a fintech entity in Gift City, and it has obtained registration from IFSC in current financial year, say financial year 24-25. Then starting from today for the next 15 years, out of these 15 years, it can avail tax holiday for any 10 consecutive years. So normally it happens that when an entity starts its operations for say first 2 years, 3 years, 5 years, it will normally not be earning profits depending on its business operations and the market. So the government has said that, okay, you can select any 10 out of 15 years block. But once you make a selection that, okay, I want to avail tax holiday under Section 80 LA, say you make that selection in year 3, then from year 3 consecutively for next 10 years till year 13, you will have to avail the tax holiday. So you cannot take this exemption, this deduction in piecemeal. Say you obtain the tax holiday for first 3 years and again in fourth year there's a loss, so you take a break. No, once you've started, it is for 10 consecutive years out of 15 years. The deduction under Section 80 LA is available only if the assessee furnishes report in Form 10 CCF along with the return of income. So if you are availing this benefit in the return, if you are taking a tax holiday, then in addition to the return of income, the assessee will also have to file a report in Form 10 CCF. And this 10 CCF form needs to be obtained from a chartered accountant. So that is where our role comes into picture, where the chartered accountant will have to certify that the deduction which the unit is availing under Section 80 LA is in accordance with the provisions and it is correct. Now, what we discussed was the tax holiday under the normal provisions of Income Tax Act. But as we all know, there are provisions for MAT or AMT as well. So if a company or an LLP obtains tax holiday, while under the normal tax provisions, it would not have to pay any income tax, there are MAT provisions which come into picture. So the company will still be liable for MAT on its book profits. However, the relaxation for IFSC units is that instead of the routine 15%, which a normal company has to pay on the book profit, the rate of MAT for an IFSC company is only 9%. So there is a reduced rate of MAT. However, in 2019, the government had introduced Section 115BAA, wherein it said that if you opt for a tax regime in 115BAA, then you will be eligible to pay tax at a reduced rate of 25.17% instead of the routine 30% plus surcharge cess. At the same time, the government said that, okay, but if you are availing the benefit of 115BAA, wherein you are paying normal tax at the rate of 25.17%, you will not have to pay MAT. So you are out of the MAT regime altogether. At the same time, the government said that if you are going for 115BAA, you will not be eligible for any tax holiday provisions. However, they have carved out Section 80LA and few other provisions from this list. So if a company which is set up in IFSC opts for tax regime under 115BAA, it can still avail tax holiday under 80LA and MAT will not apply. So this becomes really beneficial for the IFSC company where it does not pay any normal tax because it avails 80LA benefit, and because it has opted for 115BAA, it will not have to pay any MAT on its book profits as well. However, the 115BAA benefit is available only to a domestic company. So say for example, if there is a foreign company which has set up a branch in IFSC, and it is very common for foreign companies to set up units in IFSC. If the foreign company has set up a branch in IFSC, then that branch will still be liable for MAT at the rate of 9% if that branch is regarded as a permanent establishment in India, which most likely it would be, but we'll have to evaluate the facts of each case. And that is where I think it becomes very important to advise to the client to suggest, to evaluate whether that foreign company too should come up here as a branch, it should come up as a company, because in both the cases, the tax implications will vary. If it comes here as if it sets up a subsidiary here in IFSC, then it will become a domestic company and MAT will not apply. However, if it sets up a branch, then while the normal tax will not be applicable, but the rate of MAT of 9% will still apply. Next is for LLP, there is still AMT which will be applicable at the rate of 9%, while the routine LLP MAT AMT rate is 18.5%. For IFSC LLPs, this rate is only 9%. Here it is important to note that there is no section like 115BAA which is otherwise applicable to companies. So there is no blanket exemption from AMT. AMT will still apply, but at a reduced rate of 9%. Now, coming to the taxability of distribution from IFSC units. So we discussed what is the taxability of the profits which are earned by an IFSC company or IFSC LLP, the normal tax provisions, the MAT provisions, the AMT provisions. However, the distribution of these profits will also be taxed in a peculiar manner. So if we say there is an IFSC company which is distributing its profits to its shareholders, if the shareholders are resident shareholders, then they'll be taxed on the dividend income at the routine applicable tax rates, because there is no tax holiday or no tax benefit. So just like a normal shareholder who receives dividend income from an Indian company, and a shareholder of an IFSC company will also be taxed in the same fashion on the dividend income. However, for non-resident shareholders, the Income Tax Act provides for a reduced rate of 10% under Section 115A. Generally, if there is a non-resident shareholder, then he is taxed at 20% under the Income Tax Act on the dividend income. Of course, he can still be taxed at a lower rate under the treaty if the treaty provides a lower rate. However, for the IFSC company, there is an outright blanket rate of 10%, which is there on dividend. So this becomes very beneficial for the non-resident shareholders. On the other hand, if it's an IFSC LLP distributing profits to its partners, then that entire profit becomes exempt from tax, because any profit distribution by LLP to a resident or non-resident partners is not liable for tax under Section 10(2)(a). So if we understand this with help of an illustration, we can see that if there is a company and it has profits of 100 rupees, it will avail deduction under Section 80LA. There is a tax holiday of 100. The taxable income is nil. So the corporate tax is also nil because of 80LA deduction. MAT will also be nil, as we saw, because there is 115BAA which provides exemption from MAT. And the funds which will be available for distribution to shareholders will be 100. So the shareholders will now get 100, but on that 100, they will have to pay tax. If it's a resident shareholder, then they'll have to pay at the applicable rates. If it's a resident shareholder, individual shareholder, then he'll have to pay tax as per the slab rate. But if it's a non-resident shareholder, then the tax rate is only 10%. So in a way, we can see that the entire 100 rupees reaches as 90. So there is only an overall tax cost of 10 in India on the profits which are earned by the IFSC company. Of course, The non-resident shareholder may still be taxed on that dividend income in his home jurisdiction as per their applicable laws. And there he can offset the tax which is paid of 10 rupees in India, the tax withholding cost of 10 rupees. On the other hand, if we talk of LLP, the entire LLP profit of 100 will be eligible for tax holiday under 80 LA. So there is no corporate tax which is it's paying in India. However, the AMT of 9% will be payable. So there is a 9% AMT which will be payable in India, and there is a cost of 9 rupees. So the partners will get 91 in their hands after paying AMT, but this entire 91 becomes tax exempt then for the partners. So the partners need not pay any further tax because it's in nature of share of profit. Coming to other tax incentives for gift IFSC, the government has introduced section 47 clause 7AB, which says that if there is a non-resident and he is transferring certain prescribed capital assets on stock exchange in IFSC, then such transfer will not be regarded as a transfer for the purpose of section 45, meaning thereby such transfers will not be liable for capital gains tax. So as we discussed, in GIFT today, there are two stock exchanges. One is NSE IX and the other is BSE INX, both the subsidiaries of BSE and NSE. And there are transactions which are allowed to be undertaken on these stock exchanges in IFSC. If a non-resident is dealing in any of these securities, say specified bonds, GDRs, rupee-denominated bond of Indian company, derivatives, and derivative here will also include commodity derivative, foreign currency bonds, units of mutual funds, AIFs, foreign currency denominated equity shares, bullion depository receipts, then all these transactions will be completely exempt from capital gains tax. So what we were discussing a while ago for bullion exchange. So if there is a foreign company which has obtained trading membership on the stock exchange or on the bullion exchange in IFSC, then it can transact into bullion depository receipts, earn gains on those transactions, and still not pay any tax in India because those profits are completely exempt under section 47(7)(ab). Similarly, the government has very recently come up with a direct listing framework on stock exchange and gift IFSC. So what this framework says is that if there is a company in India, it is an unlisted company, it is not listed on BSE, it is not listed on NSE, but it wants to raise foreign funds, then it can list its shares directly on gift exchange, and those shares which will be listed on the exchange in IFSC, if they are traded by the non-resident investors, then capital gains on trading of those shares will not be liable to tax for the non-resident investors because of this section 47 benefit. This is the other list of exemptions which is provided under the Income Tax Act under section 10. Section 10(4)(e) says that any income of non-resident from transfer of ODI, offshore derivative instruments, mainly being the P notes, that will not be liable to tax. Section 10(4)(f) says that if there is a non-resident and he has given a ship or an aircraft on lease to an aircraft leasing or a ship leasing company in IFSC, then the lease income of that non-resident, if it's an operating lease, then it will be taxed in form of royalty. If it's a finance lease, it will be treated in nature of interest. But that entire royalty or interest income will not be taxable for that non-resident because of the exemption under section 10(4)(f). 10(4)(g) says that if there is an income of a non-resident from portfolio of securities which is managed by a portfolio manager, then to the extent such income accrues or arises outside India, that income is not liable to tax in India. Section 10(4)(h) is a recently introduced exemption under section 10, which says that if there is a non-resident or an IFSC unit, and that is primarily engaged in the business of leasing of an aircraft, then any capital gains which that IFSC unit or that non-resident earns from transfer of shares of a domestic company being a unit of IFSC will not be taxable. So say, for example, there is a foreign company, say a UAE company, which has formed a company in IFSC, and that IFSC company is engaged in aircraft leasing activity. tomorrow, if that Dubai company sells the shares of the IFSC aircraft leasing company, if it divests those shares, then that income will not be liable to tax in India by virtue of exemption under Section 10(4)(h), provided that aircraft leasing company is availing the 10-year tax holiday. If so, you are selling the shares in that 10-year bracket, then the non-resident will not be liable for any tax on the capital gains. Other important benefits in GIFT are that there is no STT, no CTT, no securities transaction tax, no commodities transaction tax on any trade that is undertaken on the NSE-IX or BSE-INX platform. This means that there is a very reduced transaction cost. So in addition to tax benefit, there is also a reduction in the transaction cost for the investors when they trade in securities on the stock exchange in IFSC. So we can see on one hand, the finance minister increasing the rate of STT for F&O, futures and options on the normal stock exchange in India in the recent budget. On the other hand, there is complete removal of STT and CTT for transactions which are dealt with on the IFSC exchanges. Also, if there are bonds which are listed on IFSC exchange and there is any interest which is paid on those bonds to a non-resident, then there is a reduced tax rate of 9%. So today, if there is any non-resident who has, say, subscribed to bonds which are issued by an Indian company, and that Indian company has, say, issued foreign currency denominated bonds, and those foreign currency denominated bonds are subscribed by non-resident, and the Indian company has raised foreign currency borrowing by virtue of these foreign currency bonds, then that the interest which is paid on these bonds is liable for 20% tax for the non-resident bondholder. As against that, if these bonds are now listed on IFSC exchange, then the tax rate will be only 9%. This was, of course, 4% till 1st July 2023. Now they have increased to 9%, but it still is beneficial as compared to the other bonds. Moving ahead, there are certain exemption provisions for TDS. So today, if we see there is an IFSC company and if it is earning any income in IFSC, then its business income is not liable to tax because of the Section 80LA deduction. That is where the government came up with TDS exemption after realizing that, okay, there is an IFSC company, its entire income is exempt. Then why should a payer who is paying any income to this IFSC entity, why should he deduct tax at source under the respective provisions of Income Tax Act? Because that would lead to a cash flow leakage. On one hand, the income is exempt from tax, but on the other hand, those income receipts are subject to TDS, then that IFSC entity will have to avail a refund. So it's just blockage of cash. It's a liquidity crunch. You are unnecessarily blocking your funds and you are getting refund once you file the return at the end of the year. That is where the government has come up with notifications from time to time under Section 197A, wherein it has said that if there is an IFSC unit which is receiving prescribed kind of receipts, so we have listed those receipts here, then there will not be any requirement to deduct tax on such kind of receipts. So say, for example, if we take the example of insurance company, normally the insurance commission of an insurance company is subject to TDS under Section 194D. But if there is IFSC unit and it is earning an insurance commission, because that will be eligible for tax holiday under Section 80LA, the government has said that, okay, the payer will not be required to deduct any tax on this insurance commission. Similarly, if there is a fund management entity, professional fees earned by the fund management entity under 194J will not be taxable. Broker dealer, if the broker dealer is earning dividend income, no tax on, or no TDS on that. Similarly, a distributor will also not be liable for TDS under 194H. So in the capital markets, market segment, which we discussed earlier, there is also an avenue for distributors to obtain registration from IFSCA such that they can distribute capital market products to non-resident investors and vice versa. So if there are foreign products, they can be distributed to Indian investors. If there are Indian products, they can be distributed to foreign investors. So any distribution fee and commission fee that will not be subject to TDS under 194H because the income would as such be exempt. So these are all those list of incomes: aircraft leasing, ship leasing, any lease rentals which they earn, they will not be subject to any TDS. However, this exemption from TDS is applicable only if the payee files form number 1 on the income tax portal. So the Income Tax Act has prescribed form number 1, which says that you have to provide certain details of the IFSC activity which you are undertaking. And you will also have to mention under that you have started availing tax holiday. So it is very important to note here that, say, for example, you have started your operations in year 1, and say you decide to opt for tax holiday in year 3, then you can file form number 1 only in year 3 because your tax holiday period begins in year 3. So technically, then you are not eligible to avail any of these TDS exemptions in the first 2 years, because in those 2 years, you are not availing tax holiday. So, and which is logical, because if you are not availing tax holiday, they will not provide you this TDS exemption. So the payee will have to furnish form number 1. They'll have to file form number 1 on the portal. They'll have to furnish form number 1 to the payer. And based on that form number 1, the payer will then not deduct tax. So it is similar to a lower withholding certificate, which normally a payee obtains from tax department. Here, the government has said that no need to approach the department. You simply file a form on the portal, submit that form to the payer. Based on that, the payer will not deduct any TDS. And this relaxation, as we discussed, will be available to pay only during the period of 10 years where the deduction under ATLA is being opted. Additionally, there are other tax exemptions for non-resident units. So if there is a non-resident which has provided a loan to an IFSC company, then any interest income which the non-resident earns on this borrowing from IFSC unit will not be taxable in India. So the government has exempted this under Section 10. And because it is not taxable in India, this particular interest income will not be subject to tax. So we have seen in many cross-border arrangements that today, if there is an Indian company which avails a borrowing from a non-resident, generally these are grossed up arrangements, wherein the non-resident says that we will not bear any withholding tax cost. The entire withholding tax cost will be on the Indian borrower. So for that purpose, if there is a non-resident, it has given a loan to an Indian company which is set up in IFSC, there is an entire exemption on the interest income for the non-resident, and consequently, no need to withhold tax on that. Similarly, if there is a foreign company which has given an aircraft or a ship on lease to the IFSC unit, then any aircraft and ship lease payments which are made by the IFSC unit to the non-resident entity will not be taxable, and they will not be subjected to any withholding tax in IFSC. Coming next to taxability of fund and its investors, there is a separate regime under the Income Tax Act for fund and fund management entity. So a typical fund structure would look like this. There is a fund which is an AIF set up in IFSC, which would normally be formed in form of a trust or an LLP. Generally, trust is preferred. This fund will be managed by a fund management entity, the fund manager, the AMC, which will also be set up in IFSC. There will be a trustee if the fund is set up in form of a trust. There will be investors who will be investing in the fund. And then this fund, after pooling funds from investors, will invest in different investee entities. The fund management entity, the FME, will be entitled for tax holiday under Section 80 LA, which we discussed in the earlier slides. Now, coming to the fund, there are specific provisions under the Income Tax Act for funds in GIFT City. So this AIF could either be a Category 1, Category 2, or a Category 3 AIF. If the AIF is set up as Category 1 or Category 2 AIF, then the AIF will be eligible for a pass-through status, which implies that the AIF per se will not be liable for any tax on the income which it earns from its investments. But instead, because of the pass-through status, the taxability will flow in the hands of the investors. The investors will have to pay tax as if they had directly made these investments. So very important to note, there is no exemption for the investors even though they are investing through gift AIF, there is no tax holiday extended to the investors if that's category 1 or 2 AIF. Now coming to category 3 AIF, a category 3 AIF will not have any pass-through status, which implies that the tax liability will be at the fund level. And if that fund is set up in form of trust or an LLP, then the investors will then not be liable for any further tax. However, if the AIF has been set up as a category 3 AIF and all its investors are non-residents except the management entity, because normally the fund manager will also have certain units in the fund as skin in the game. So apart from the FME, if there are other investors who are all non-residents, then certain income streams of the AIF will be completely tax exempt. So those income streams are listed here. One is income from transfer of capital assets, which are prescribed under section 47(7)(ab). So very important is, say for example, if there are, and which are traded on the gift exchange. So say for example, if there are derivatives which are traded on NSE IX, so there's gift Nifty, and the fund is dealing in those derivatives which are traded on gift exchange, then that entire income, capital gains income, will not be taxable. Similarly, income from transfer of securities other than shares of an Indian company will also not be liable for tax for the fund. So which is a game changer for the funds in IFSC. So say for example, there's a category 3 AIF and it is a hedge fund whose main strategy is to deal in derivatives on NSE, BSE, even though in mainland, if not in GIFT City. Then that entire income becomes tax exempt. If that fund is dealing in mutual funds, that fund is having income from transfer of, say, bonds, debentures of Indian companies, that income is not subject to tax. Similarly, if that fund has invested into offshore securities, then that income will also not be liable to tax in India. This particular exemption for the fund will be available only to the extent the income is attributable to the units held by non-residents, which implies that, say for example, if out of 100%, say 95% units are held by non-residents and 5% units are held by the fund management entity, the manager, then out of total income which is liable for which is entitled for exemption, 95% will be completely exempt, but the 5% income which is attributable to the fund manager, that will still be liable for tax in India as per the applicable provisions. As we discussed, the income of unit holder from the fund will be exempt. So whether the fund is liable for tax or not, the unit holder will not be liable to any tax on any income which it receives from the fund. And even if it transfers the units, the unit holder transfers the units of this fund, then that will not be liable for any tax under the Income Tax Act because of deduction or exemption under section 1023 FBC. Category 3 AIF, as we discussed, certain income streams are still liable to tax. So as we discussed, if the fund, say, trades in shares of an Indian company that is not exempt under section 10(4)(d), then that will be liable for tax at, say, 20% if it's a short-term capital gain, and if it's a long-term capital gain, then it's 12.5%. So that is at par with normal investor. However, any income from securities, which is in nature of interest or dividend, that will be liable for tax at a very concessional rate of 10%. Normally, these income streams are liable at 20% under the Income Tax Act, subject to treaty benefit. But here, for specified funds, this kind of income will be taxable only at 10%. There are also tax neutrality provisions under section 47 for relocation of offshore funds to GIFT IFSC. So as we discussed, the main objective of government coming up with GIFT provisions was to encourage people to come onshore, for the offshore income to be shifted onshore. So there were many funds which were located in Mauritius, Luxembourg, Singapore, and we have seen many of the clients shifting their base from Mauritius to GIFT IFSC. Now here, a very crucial aspect is that if there is a Mauritius fund, it is holding shares in Indian companies, say it is holding shares of listed companies in India, and now it decides to relocate to IFSC. So there is a specific framework by IFSC which says that that fund can move its base to GIFT IFSC. But if it does so, what will happen is that the Mauritius fund will have to transfer the securities of Indian companies to the GIFT fund. As soon as it undertakes this transfer, capital gains tax will come into picture because there is a transfer of Indian security, which are Indian capital assets. In order to encourage offshore funds to relocate to GIFT in a tax neutral manner without entailing any tax cost, Section 47 has been amended to provide that such kind of relocation will not be liable for any tax either for the offshore fund or for the investors of the offshore fund, provided such relocation happens by 31st March 2025. So the government has been extending this date in every budget. So right now the sunset date is 31st March 2025. Then there are certain other relaxations for the investors of fund. So if there are non-resident investors of category 1 AIF, category 2 AIF, and specified fund that we discussed, which is a category 3 AIF, having non-resident investors, then these kind of non-resident investors will not be required to obtain PAN in India, and they'll not be required to file return of income in India, provided they don't have any other income in India. So because if they have any other income in India, naturally they would have to obtain PAN and file return in India. But if they are having income exclusively from GIFT IFSC funds, then they are not required to obtain any PAN. And this has been very encouraging. We've seen funds saying that this has been received very positively by the investors because they see obtaining PAN as a lot of administrative hassle, and then they are always under the apprehension that they'll be under the scrutiny from the department. But because there is a blanket exemption, this really encourages the investors to invest in India. However, it is important to note that this relaxation will be available only if the non-resident investor, as we mentioned, does not have any other income in India, and TDS has been deducted at the applicable rate by AIF if it is applicable. So if there is a specified fund, category 3 fund, then it will not have to withhold any tax because, as we discussed, under section 1023 FBC, the unit holder will not be subject to any tax. However, if it's a Cat 1 fund or Cat 2 fund, it will withhold tax at the applicable rates, and then that non-resident investor does not have to file any further returns in India. And they will also have to furnish certain specified information to the fund and the broker here. So say, for example, there are very basic details: tax identification number of their resident jurisdiction country, their contact details, their address, and all those details have to be furnished to the fund. And then the AIF will have to furnish a quarterly statement in form 49BA on the income tax portal to the department, because the department wants to know who are these investors who have not obtained PAN, but their income is being subjected to tax in form of TDS. So that reporting will have to be done, but the administrative formalities of obtaining PAN and filing return for the non-resident investors is done away with because of these relaxations. Next is transfer pricing. Any branch which is set up in IFSC. So if it's not a separate legal entity, if it's a branch, say for example, there is an Indian company which sets up a branch in IFSC, then any transaction between that IFSC branch and its DTA operations will be subject to transfer pricing provisions because of specified domestic transaction provisions. So there are SDT provisions under section 92BA read with section 80A, which say that any transaction between a tax holiday undertaking and a non-tax holiday undertaking will be subject to transfer pricing. Similarly, just like any normal transfer pricing compliance, if there is an IFSC company having transactions with its non-resident associated enterprise, then that will have to comply with transfer pricing provisions because it is similar to a transaction between a resident and non-resident AE. Coming last to the compliance requirements, the specific compliance requirements for IFSC units, we normally see that if there is any entity in India which makes remittance outside India and that remittance is not taxable in India for the non-resident, then the Indian entity has to file Form 15 CA in Part D. However, for IFSC company, the government has introduced a relaxation that if your remittance by IFSC unit is not subjected to any tax in India, then it will not be required to be this particular Form 15 CA filing is not applicable in Form Part D. However, there is an additional compliance requirement which has been introduced in the Income Tax Act in Rule 37BAA, which says that IFSC unit will have to file Form 15CD. It's a new form which has been introduced. A Form 15CD has to be filed on a quarterly basis, wherein they'll have to furnish details of all remittances which they have made to non-residents on a quarterly basis. So say, for example, if any remittances have been made by IFSC unit to non-resident in the quarter July to September, then by 15th October, the due date is 15th of the next month. So by 15th of October, they'll have to file Form 15CD on the income tax portal, just like you filed Form 15 CACB. This 15 CD needs to be filed by the IFSC company, providing details of the overseas remittances. So I think this is it as far as the direct tax provisions are concerned. I now hand over to Amrin, who will take up the indirect tax provisions.
Thank you, Joy, and thank you everybody for joining us on a working day in the evening time, where we are fighting to meet the deadlines. But hope this is going to be a very useful session for all of you, as we are dealing in with the provision as well as the professional opportunities that can be there, which can be helpful to you. So to start with, we will first understand that which are the units or the kind of units which are included as a part of indirect tax provisions, and the definitions and from where it is coming. So taking you through SEZ. As such, IFSC is considered as a different from SEZ, but the regulations and laws of SEZ itself is applicable to an unit in GIFT City, IFSC. So in SEZ, the major definitions they have covered is a co-developer, which means a person which has been granted by the government a letter of approval. Then there is a developer who can be a person or a state government in itself who has been granted by central government a letter of approval to work as a co-developer in an SEZ. And then finally it comes as a unit wherein the major organizations and the businesses are covered and are defined as a unit. Unit means an entity which is an entrepreneur and who does an offshore banking or any other business which is defined or governed under the SEZ regulations. So now taking it through the GST provisions, stating that which will be considered as SEZ or SEZ unit or developer in GST Act. So IGST Act categorically section 2 defines the SEZ, which says that SEZ will have the same meaning which is governed by SEZ Act. Then SEZ developer, again it says that SEZ developer, the meaning has to be considered from the SEZ Act, whereas SEZ unit is not defined or not considered anywhere in the GST laws or regulations, which means we have to consider the same unit, same definition of a unit which is given under the SEZ Act itself, because it overrides the other laws and regulations. Now, while we start on the GST applicability on the GIFT City, the first question comes is, because GST is a levy which comes on a supply of a goods or a services. So if I'm supplying any goods or a services, what kind of supply it will be considered? So section 7 categorically states that if a supply is done by a SEZ developer or an SEZ unit, it will be considered as an interstate supply because it is governed under under the IGST Act, which means if I am supplying to an SEZ unit or a developer, it will be considered as an interstate supply. So many times we get a question. Let us say there are two SEZ units or developers and they are supplying services internally. Let us say there is a unit in GIFT City, unit A in GIFT City, which provides services to unit B in GIFT City. Whether it will be considered as an intrastate supply or an interstate supply. So here the answer will be, it will be considered as an interstate supply because even though a provider is SEZ, the recipient is again an SEZ, right? And section 7 of IGST Act categorically covers both the services received by or to an SEZ unit or a developer. It will be covered as an interstate supply and hence IGST shall apply on the supply. Also, there is a question in the mind of industry whether SEZ will be considered as a part of India or not, whether the provisions of CGST Act should apply thereon or not. So to answer that, we have considered the provisions from CGST Act. So if I take you through the section 1, SEZ Act should apply to everybody and it should apply to all of the India, excluding certain parts and provisions. Now let us jump on to the definition of India. Okay, I'll read it for the benefit of everybody. India means the territory of India as referred in Article 1 of the Constitution. Its territorial waters, seabed and suboil underlying such waters, continental shelf, exclusive economic zone and any other maritime zone. Territorial water, continental shelf, exclusive economic zone and other maritime zone, which means the definition of India nowhere excludes the SEZs or the FTWZs which are located in India, which means not like in Service Tax Act. In Service Tax, the SEZ was categorically excluded from the definition of India. It was not covered as a part of India, and hence the SEZ Act was not applicable to the SEZ units. Whereas in GST, the GST Act is very well applicable to all the units and developers who are located in SEZ. So let us say if I'm covered into GST Act, have my supplies are not taxable, or if taxable, what are the concessions available to me? So again, jumping into IGST Act, because this is an interstate supply, the IGST Act provisions will prevail on the CGST provisions. So taking to section 16 of IGST Act, which defines zero rated supply. So subsection 1 of section 16 says zero rated supply means any of the following supplies of goods or services are both, namely A, export of goods or services are both, or B, supply of goods or services are both for authorized operations to a SEZ unit or a developer, which means the supply of goods or services done to an SEZ is governed under a zero rated supply. So there was a myth in the industry stating that supply of goods or services to SEZ is equivalent to an export of goods or services. This was true in case of service tax regime, but not in GST. Why? Because the definition of India, which we discussed in the earlier slide, categorically covers the SEZ, which means if I say export of goods, it has to be moved outside India. Because in case of SEZ, the goods or services are not moving outside India, they have categorically covered supply to SEZ as a part B. Now there is another change which came by way of Finance Act 2023, wherein they have included the word authorized operations, which means earlier if I supply any goods or services to SEZ, it was covered as a zero rated supply and I can supply without payment of tax or with payment of tax, wherein I can get the refund. Whereas now, if I'm supplying to an SEZ, only and only in relation to authorized operations of that SEZ unit or developer, the exemption or the zero rated supply benefit will be available. There is also a clause, a subsection 4, which is included as a part of Finance Act 2023, wherein they have carved out. They have mentioned that, as we all are aware, that in case of GST, there are two benefits are available. You can either export with payment of tax, wherein you get an automatic refund. And there is an export without payment of tax, wherein you export, don't pay tax, and you take refund of accumulated ITC. Whereas now the government has restricted that they can very well specify and mention a class of person or a class of goods or services, wherein only the specified class can export with payment of tax. We have already received a notification wherein they have excluded the tobacco and related products. Hence, if anybody is supplying tobacco or related products, they cannot export with payment of tax, wherein they get a direct refund through the filing of shipping bill. Just to summarize all the provisions which we discussed in earlier slides, that if I'm supplying to or supplying from SEZ, what will be the tax applicability on that? So just to debrief on that, if I supply goods or services to SEZ, which means it's an inbound transaction for an SEZ unit. If I am importing goods into SEZ from outside India, then SEZ is not required to pay GST. If it is coming from DTA, in that case, it will be considered as a part of zero rated supply. Even if I'm importing, there are customs exemptions and benefits available and no GST is applicable thereon. If anybody is providing services to SEZ units for their specified operations, in that case also, it will be covered as a zero rated supply for DTA unit and no GST is applicable thereon. If an SEZ unit is providing goods or services to somebody outside India, first we'll take and then to the DTA, it's an outbound transaction wherein we export the goods or services outside India, both will be considered as a zero rated supply. As I said, that SEZ is very well part of India and all the provisions and legal regulations of GST is applicable, and hence even if I am providing something outside India, it will be covered as an export of goods and services as covered under zero rated supply section 16, and no GST will apply on that. Then the third and the very important part comes is if an SEZ supply goods or services to somebody in DTA. So if I'm supplying any goods to DTA, it will be considered as an imported item for the recipient, and the recipient person will file a bill of entry. He'll discharge custom duty thereon, and he'll also pay GST thereon. If I'm providing any services from SEZ to DTA, in that case, GST is very well applicable. And the SEZ unit who is providing services, this is very much important in case of GIFT IFSC. Let us say if I am sitting in GIFT IFSC, and if I'm providing any services to outsider who is sitting in Ahmedabad or let us say Chennai, anywhere in India, in that case, I need to take registration and I need to collect and discharge GST on those transactions. If there are two SEZ units or developers and providing services or receiving services inter SEZ, in that case, GST is not applicable because it will be considered as a zero rated supply. So this is more or less a provision. This was more or less a summary of the levy part of the GST, which is very much important. So first we need to understand that where and how the GST will be applicable in case of SEZ supplies. So now coming from the DTA perspective, earlier we spoke from the SEZ perspective, whether it will be covered as zero rated supply or not, why the levy, from where the levy is coming. Now coming from the other perspective, it is a DTA supplier. And if he wants to supply to SEZ, let us say today I'm sitting into GIFT City. Okay, and if I'm taking a chartered accountant services from anyone sitting in Chennai, and so the Chennai unit, whether that entity can supply me with payment or without payment. So yes, both the options are available because it is covered under zero rated supply. So if the DTA supplier opts for with payment of tax, again, there are two options available. Either the supplier sitting in Chennai will bear the taxes, which means he'll not collect the taxes from SEZ unit. He will pay the taxes and he will file a refund claim from the department directly for the taxes they have paid. Or let us say the Chennai unit is charging GST on me. I am reimbursing that portion. Now I, as a unit in SEZ, a unit in GIFT City, I can take credit thereof. And when I am further exporting any goods or services outside India, I can either use that credit if I'm opting with payment of tax option. If not, I can claim a manual refund of the credit accumulated with me as an SEZ unit or developer. Let us say as a DTA supplier, you want to take an advantage of without payment of tax, you can very well take that. You can take an LUT, which is available on the GST portal. You can file an LUT and you can supply without payment of tax. Now the question comes as if the services are covered under reverse charge mechanism. Let us say if I'm taking an advocate services, wherein an SEZ unit is required to discharge GST under reverse charge mechanism. So in that case, SEZ unit have an option to not discharge GST under RCM on the basis of his self LUT. Let us say if I, as an SEZ unit, hold an LUT, I am not required to discharge GST under reverse charge mechanism on the basis of LUT which I hold. So this is a very litigative part, and many of the departmental officers also litigate this in detail, that LUT cannot be applicable in case of RCM. Whereas there is, you can say, clarification kind of an internal public notice which is issued in case of GIFT IFSC in somewhere in 2019, wherein the departmental authorities have said that RCM is not applicable considering the LUT provisions. Okay, so as we already discussed that GST provisions are very well applicable to SEZ unit. Now the next question will come is, what is the process of registration and how I'm supposed to take the registration under GIFT IFSC? So registration has to be applied within 30 days once I'm liable to register in the GST provisions. A person who has a unit in SEZ or who is a developer in SEZ has to take a separate registration, which is distinct from a normal business, which is located outside India. Let us say, though of course, we all know that if I have business in two different states, I have to take two different registrations. Let us say I already have a registration as a chartered accountant firm. I already hold a registration in Ahmedabad, which is located in Gujarat in itself. Now I want to open an office in GIFT IFSC. Am I supposed to take a new registration for the same state? Yes. I am supposed to take a new registration as an SEZ unit or a developer, whichever business I hold, and it will be distinct from a registration which I have in Ahmedabad. So now next question comes is, in SEZ only I have 2 units, or I am an SEZ developer and I am an SEZ unit. Am I supposed to take 2 different registration for the same GIFT IFSC? Yes. Even being the same PAN holder, if I hold 2 SEZ developer or 2 SEZ different units and same SEZ, I am required to take 2 different registration, and both the registration will be considered as 2 distinct person in terms of the provisions of GST. So just to drag down on what I have to select. So if I go in detail in the GST law, there is no separate provision which state that you have to take a different unit registration for a unit and a developer, but the registration portal in itself provides you 2 different options. If you're an SEZ unit, you are compulsorily required to take a registration as a unit. And if you are an SEZ developer, you are compulsorily required to take a registration as an SEZ developer. So you have to choose any one of that. And post choosing that, you have to just give details of your SEZ unit, approving authority detail, your LOA detail. These details you have to upload, which is in addition to whatever you submit as a part of your regular GST registration. Now coming to the compliances. So let us say as a chartered accountant, if you want to provide services to an SEZ who is registered there, and if you want to file the GSTR 1 and 3B, which transactions and where to report in the GST return. So let us say I am a supplier, because we are categorically working on GIFT IFSC, which provides the services. I have covered only services portion. If a supplier is an SEZ, the recipient is in DTA, I am supplying services. Let us say if the recipient is registered, it will be recorded in B2B supply, because I'll be collecting tax and discharging it to the government authorities. Other way around, let us say if the recipient is not registered, it will either go in B2CL or B2CS, considering the amount involved in the transaction. The second part, if there is an SEZ unit who provides services to other SEZ unit, if the other SEZ unit is registered, it will be considered as B2B supply, because I'll be doing a zero rated supply. And you have to report it into 6B, supply made to SEZ unit or developer. And even if the recipient is not registered, it will be recorded in the same manner and phase. Number 3, SEZ to other SEZ. Let us say GIFT IFSC is providing services to anybody sitting into Kanla SEZ unit or any SEZ located in Chennai or Kerala. In that case, it will be recorded in the same manner if both were in SEZ unit, which is we discussed in point number 2. Last but not the least, if I am an SEZ unit, I'm providing any services to any entity, any business entity located outside India. In that case, it will be reported as an export of service, because now the recipient is not SEZ, and hence it has to be covered as an export of goods or services. Whereas in 3B, it will very well be covered in zero rated supply. Okay, now taking you through the other opportunity which is available to us as a chartered accountant, where we can support to the SEZ unit or a DTA unit who are supplying goods or services to SEZ in form of a refund. Okay, so which kind of refunds or which types of refunds are covered when I'm supplying or receiving goods as an SEZ unit or a developer? So let us say there is a supply of goods or services by DTA to SEZ with payment of tax. In that case, the refund claim very well goes in a manual form. If it is goods, then in that case, there will be a shipping bill and they'll get an automatic refund. But in case of services, with payment of tax, there's a manual refund filing process and the DTA unit is required to file a refund, wherein we as a chartered accountant can support the DTA unit. If there is an export of goods by DTA to, SEZ to DTA with payment of tax, in that case, the DTA unit, we can support them by taking the credit and refund if they're further exporting the same goods. If the SEZ is providing any services to DTA unit with payment of tax, and the DTA unit is into business of further export of goods or services, in that case, we can help them by taking refund of the accumulated ITC which is of the taxes which is collected by SEZ unit. Supply of goods or services by DTA to SEZ unit under LUT, we can very well help them in filing and availing the LUT and the manual refund claim of accumulated ITC. Another way around, let us say if I'm an SEZ unit, I'm procuring goods with payment of tax or under LUT, we can help the SEZ units to file the manual refund claim. It very well goes with the jurisdictional officer and it is not at all simple. We can't say that if a unit is located in SEZ, the refund processes can be simpler or it is more easy than the DTA unit. No, not at all. It is as complicated as we're filing DTA units and you can very well provide those services to units located in SEZ. So NAV taking you all through the provisions of customs because we discussed that there are also the benefits and exemptions available to units located in SEZ in case of imports. To taking you through the customs provision, what import means. So import with its grammatical variations means bringing something into India from a place outside India, which means, as we discussed the definition of India, SEZ is very well covered in the definition of India. And hence, if I'm taking anything out from India, it is covered as covered in the provisions of import. Now, if I take Section 2O of SEZ Act, so what SEZ Act defines import? So as per SEZ provisions, import means bringing goods or services in SEZ by a unit or developer from a place outside India, receiving goods or services by unit or developer from another unit or a developer. So the SEZ Act covers both the provisions. If I am importing something from outside India, as well as if I am taking some goods or services from another SEZ unit, both are covered into the definition of import. But it is very well, I would just like to highlight on one point that in none of this definition defines any procurement from DTA by SEZ, which means if SEZ unit is procuring anything from the DTA unit, it is not at all covered in the definition of import and hence no provisions of customs should apply thereon. What are the exemptions which are provided to an SEZ unit in terms of the customs provision? So Section 26 of the SEZ Act provides an exemption, drawbacks and concessions to every developer and units. Entrepreneur means a unit from exemption of a custom duty. Also, it is very well important that SEZ Act provides an exemption. SEZ Act, of course, has an upper hand on over all the other acts and regulations, but the similar provision has to be there in the Customs Act and GST Act. So, to be in line with the SEZ Act, the notification number 64 2017 of Customs provide an exemption of IGST and custom duty to all the SEZ developer or unit, and the similar notification is also provided into notification number 18 by 2017. So the joint reading of all these three provisions, or all these three, two notification and one provision, if I'm importing anything into SEZ, the GST and custom duty thereon are exempted. So there are many processes. If I now talk about the regulations of SEZ, it provides many processes and it equally applies to a unit or a developer in GIFT IFSC If I name the process, if I'm importing from a port, airport, or a land custom station, then there is a different process. If I have a high value parcel, if I'm importing something through, a courier or something by a gem or jewelry unit, then the process is different. If I'm importing something by way of a baggage, then the process is different. If I'm importing an aircraft, because GIFT IFSC very well covered the import of aircraft and ship for the purpose of further leasing. In that case, the process is different. But we cannot go into each and every process as of now. So I'll just take you through a specific process which is a very generic. So it will be same for everybody else. Okay, let us say if I am dealing in with the process of port, airport, and land custom imports, the base process will remain same. But if it comes to a gold, silver, or an aircraft or a ship, there will be an added process, which very well can be discussed and covered as and when such transaction has been governed. So, how the process flow goes. So, whenever I'm importing something through a custom or an airport, in that case, first I have to file a bill of entry for home consumption. And the authorized officer at the port will verify the bill of entry which I am filing. It will verify the goods which are coming into. Then that bill of entry will be registered at the with the authorized officer. Let us say if I'm sitting into GIFT IFSC, the designated authorized officer will be sitting at the custom port. So that bill of entry will be assessed and registered by that authorized officer at custom port. He'll verify that bill of entry. Then he'll provide an affirmation, or he'll provide a confirmation to transfer of those goods from the port to the SSM. Let us say if I'm importing at Nhava Sheva port or a Mundra port, that authorized custom officer will provide an approval to transfer the goods from the port to the GIFT IFSC. And then at the GIFT IFSC, I'll submit that assessed bill of entry. Okay, that custom officer will assess and confirm the bill of entry, and that bill of entry I'm required to submit at GIFT IFSC unit. Once I'll submit that assessed bill of entry, the SEZ custom authority, we have a specific custom authorities, designated custom authorities as SEZ itself. They'll verify the goods at the custom station, and they'll allow for the goods for further entry in the SEZ location. So this is a very generic process which applies to everybody in general. Then let us say if I'm importing an aircraft, because that aircraft can get taken to the SEZ unit. If I am importing an aircraft or a ship, let us say if I'm imported a ship at Nhava Sheva port, I cannot take it to GIFT IFS. No, I have to sublease the same lease or sublease the same ship or an aircraft from that port in itself. In that case, the goods will not move. Then there will be another procedure where I have to file a lease agreement, the outbound, the bill of export or something if I'm exporting out of India. So those specific process, considering the transactions of parcel, the jewelry, the gems, the sheep, the aircraft will have to be considered in direct conformity. So these are the general provisions. So as I discussed in detail earlier, the supply is very well governed under the provision of GST Act, but the GST is not applicable on the same, considering it as a zero-rated supply. And I'll not say export because it is not export. It is a zero-rated supply by way of governing provision of Section 16. So no custom duties applicable in case of imports. No GST is applicable for the goods or services supplied to SEZ. However, I'm very well required to maintain LUT, the tax exemption details, and etc. And all these things has to be done for an authorized operation, which is defined and governed through the letter of approval, which is granted to an SEZ unit. So this is in brief in relation to the GST or the indirect tax provisions applicable to an SEZ. And we as a chartered accountant can help them to identify whether they should use their ITC and export with or without payment of tax. They should take the credit or not. Who should bond the tax portion, we can negotiate. So generally we get the client wherein the client will come and ask us, can we negotiate? We have this many credit available with us. Can we negotiate that we'll export with payment of tax and the SEZ should take the credit? I don't want to go with a manual refund claim. What are the alternate available options? If an SEZ unit is importing something, we can help them in filing of bill of entries, taking exemption, negotiating with the customs authorities, identifying whether there are any other additional incentives or anything is available or not. So these are all the things wherein we can assist or help the units in SEZ as well as the unit in DTA who supplies to SEZ. So without taking much time, because we are already sitting at 5:50, we will keep the forum open for the question and answer session for next 10 minutes. So I and Jay both are sitting over here and we will be happy to take your questions in relation to direct and indirect tax provisions. So if we have the organizers over here, if you can please take up through the question and answer if the anybody has, and we also have shared our email IDs on the screen. You can have a note of that, and we can take your question and answer in person as well if you have. But we haven't received anything as of now. For the presentations, you can connect with the SIRC coordinators because we are not sure whether they can share or not. We have shared the presentation with them and they can share it further according to their policies.
Madam, the PPTs will be uploaded in SIRC website.
All right.
And then your video, this program also will be uploaded in SIRC FICA YouTube channel.
Okay.
Madam, kindly share your PPT, madam. Jaisha already have shared.
Both are in the same PPT. Both we have taken it from the same PPT. Both direct and indirect taxes both are in the same PPT. I guess we have looks like no benefit in the specific city.
Okay, madam.
So
Thank
see,
you.
I'll just answer the question or the point governed by Shraddha. So Shraddha, what happens is income tax is something is governed on your income. Okay, so if you're earning, you are supposed to pay, and whereas in GST, it applies on specific transaction. Let us say if I'm providing certification services to you today. Okay, so whether GST is applicable to that transaction or not, so GST is not applicable. So now there is no question of any further concession. So as such, they have exempted the tax. There is no logic for giving any additional concession. But if I take you through the concession comes from DGFT. Okay. If you have heard about the benefits of advance authorization, road tip, EPCG, so all these benefits of foreign trade policy are available to a unit in GIFT City as well as the other SEZ. But what happens is all these benefits are given to goods and not the services. Whereas GIFT City deals in with the service provision, and hence those benefits cannot be taken over to the GIFT City. But in a nutshell, there are no taxes in itself, and hence there is no incentives, which should govern the GIFT City transactions. Yes, for software transactions, the Softex and STPI, which applies to non-SEZ unit, the same provisions applies over here as well. Though there are different IT and ITAS policy, which gives some extra benefits on investments, etc. But the Softex and STPI will equally apply, which is applicable to other SEZ and non-SEZ units. No, DGFT benefits for Gift City not available because DGFT itself does not provide any benefit for service exporters, as I said. So, because Gift City is mainly into the export of services, no benefit is available. Most welcome. So if we do not have any further question, can we close the session or should we wait for any further questions?
Excuse me, I have a general question.
Yes, please.
So